Impermanent loss. Impermanent loss is a risk that can happen when trading on a cryptocurrency exchange or participating in a liquidity pool. It occurs when the value of the assets being held decreases, potentially leading to a loss for the trader or liquidity provider. Liquid mining is a type of cryptocurrency mining that involves providing assets to a decentralized exchange, Dex, liquidity pool. The value of the assets in the pool can fluctuate, leading to the risk of impermanent loss for traders or liquidity providers holding the assets for a longer period of time. Initial Coin Offering, ICO. ICO stands for Initial Coin Offering. It is a way for a new cryptocurrency project to raise money by selling some of its tokens to early investors. This is similar to how a company raises money by selling shares in an IPO, Initial Public Offering. During an ICO, a company will usually publish a document called a white paper explaining their project and the terms of the ICO. People can then buy the company's tokens using cryptocurrencies like Bitcoin or Ethereum. The company uses the money from the ICO to fund the development of their project. ICOs can be risky, as some have been accused of being scams or fraudulent. Initial Dex Offering, IDO. IDO stands for Initial Dex Offering. It is a way for new cryptocurrency projects to sell some of their tokens on a decentralized exchange in exchange for funding. IDOs are similar to ICOs, but they take place on a decentralized platform and may involve liquidity mining. Initial Exchange Offering, IEO. An initial exchange offering, IEO, is a way for a new cryptocurrency project to sell some of its tokens on a centralized exchange in exchange for funding. An exchange acts as a middleman for the sale and may review the project and its team before listing the tokens. Investors can buy the tokens using different cryptocurrencies. Initial Farm Offering, IFO. An initial farm offering, IFO, is a way for cryptocurrency projects to raise money and build a community of supporters by inviting investors to participate in a token farming or staking program. In an IFO, investors can earn rewards by holding and maintaining a certain number of tokens over a certain period of time. These rewards can come in the form of additional tokens, cryptocurrency, or other incentives. IFOs are similar to initial coin offerings, ICOs, but focus on token farming or staking rather than the sale of tokens. It is important for investors to carefully research the project and understand the terms of the IFO before participating, as the value of the tokens or cryptocurrency being offered may fluctuate significantly. Insider trading. Insider trading is the use of secret information to make investment decisions. It is illegal because it gives some people an unfair advantage over others. In the cryptocurrency market, insider trading can occur when people use secret information to buy or sell cryptocurrency. It is difficult to detect and can lead to criminal charges. People should be careful to follow the law when investing in cryptocurrency. Internal transaction. An internal transaction is a transfer of cryptocurrency or tokens within a blockchain network. It happens between accounts or wallets controlled by the same person or entity, or between smart contracts within the network. Internal transactions are faster and more secure than external transactions, which involve transferring cryptocurrency between different networks or with external parties. Internal transactions may not be visible to everyone and may not be recorded in the public transaction history of a blockchain. This can make it harder to track the movement of assets within the network, but also allows for more privacy. Internet of Things, IoT. The Internet of Things, IoT, refers to the interconnected network of physical devices that can collect and exchange data. Cryptocurrency and blockchain technology can be used in the IoT to enable secure and efficient payment processing and data exchange between devices. The integration of these technologies with the IoT has the potential to change how devices communicate and interact, and could have significant implications for various industries. Interoperability. Interoperability is the ability for different technologies or systems to work together and share information. In cryptocurrency and blockchain, this means that different blockchain networks can connect and exchange data and assets. This can be helpful when different parties are using different systems or networks to manage assets, because it allows them to share and access information securely. There are different ways to make blockchain networks interoperable, like using standardized protocols or creating decentralized networks. Interoperability is important for the growth and integration of blockchain technology. Interplanetary File System, IPFS. IPFS is a decentralized file system that allows users to share and access files in a P2P manner without a central server. It is used to store and transfer large amounts of data and can be used for decentralized file storage, content distribution, and data sharing. It can also verify the authenticity and integrity of data, making it useful for document management and supply chain tracking. IPFS has many potential applications in cryptocurrency and blockchain technology. Isolated margin. Isolated margin is a way to trade with borrowed money, using a separate account to hold the collateral, security, for the loan. This lets traders open multiple positions and manage risk more easily by keeping their main account balance separate from their margin collateral. Isolated margin is usually used by experienced traders who want more control over their risk management and can handle the added complexity of multiple margin accounts. Know Your Customer, KYC. KYC is a process that companies use to verify the identity of their clients and assess their potential risks for money laundering or terrorism financing. It is commonly used by financial institutions and other regulated companies, and is also relevant in the cryptocurrency and blockchain industry. Cryptocurrency exchanges and other companies in the industry may need to follow KYC procedures to comply with laws that aim to prevent money laundering and terrorism financing. KYC can include verifying the identity of clients, collecting and verifying personal and financial information, and monitoring transactions for suspicious activity. It is important for companies to balance the need for KYC with client privacy and security. Lambo. Lambo is a slang term for Lamborghini, a luxury car brand. It is often used in the cryptocurrency and blockchain community to joke about making a lot of money from investing in cryptocurrency or participating in a blockchain project. Layer 0. Layer 0 is the underlying foundation of a blockchain network. It includes the rules and protocols that make the network work, including how transactions are validated and nodes communicate. Layer 0 is important for the security and stability of the network and is the base for other layers to be built on top of. The features and capabilities of Layer 0 can vary depending on the blockchain and can impact the network's scalability, security, and functionality. Layer 1. Layer 1 in blockchain technology refers to the first layer of the blockchain, which sits on top of the underlying infrastructure layer, Layer 0. It includes the basic protocols and functionality needed for the blockchain to operate, such as the ability to transfer and validate transactions and store data. Layer 1 is often called the network layer or data layer, as it manages the basic data and functionality of the blockchain. It provides the building blocks for more advanced applications that may be built on top of it. The features and capabilities of Layer 1 can affect the scalability, security, and functionality of the blockchain. Layer 2. Layer 2 refers to technologies that add additional functionality or scalability to a blockchain network by operating on top of the underlying blockchain infrastructure, Layer 1. These technologies can improve performance, privacy, or security without changing the underlying protocol or structure of the network. Layer 2 protocols can be implemented as sidechains, payment channels, or other decentralized networks, and are important for improving the performance and capabilities of blockchain networks. Ledger. A ledger is a record of transactions or other data that is kept in an organized and chronological manner. In the world of cryptocurrency and blockchain, a ledger is a digital record of transactions that are recorded and stored on a blockchain network. Ledgers are decentralized and managed by a network of computers that work together to validate and record transactions, and are secured using cryptography to ensure their integrity and immutability. Ledgers are used to track and verify the ownership and transfer of assets on the blockchain, such as cryptocurrency. There are different types of ledgers, including public, private, and consortium ledgers, which can have different features and capabilities depending on the blockchain protocol. Leverage. Leverage refers to using borrowed funds to increase the size of an investment or trade. This allows traders to take on larger positions than they could afford with just their own money and can potentially increase returns. However, it also increases risk as losses can be amplified. Leverage is often used in margin trading, where traders borrow funds from a broker or exchange and are required to maintain collateral in their account. It is important for traders to carefully consider the risks and potential rewards of using leverage. Light node. Light nodes are a type of blockchain node that is smaller and uses fewer resources than a full node. They are used to verify transactions and blocks on a blockchain network, but do not store the entire blockchain history like a full node. Light nodes are often used on mobile devices or in low-resource environments, and can be used to connect to a full node or other light nodes to verify transactions without storing the entire blockchain history. Light nodes are less secure than full nodes, but they allow users to participate in a blockchain network without needing as many resources. Lightning Network. The Lightning Network is a way to make payments using Bitcoin more quickly and cheaply. It works by allowing people to make transactions directly with each other without the need to constantly update the public record of all Bitcoin transactions, the blockchain. Transactions made using the Lightning Network are settled off the blockchain, which makes them faster and cheaper. The Lightning Network has the potential to make Bitcoin more useful, but it is a complex technology and users should be aware of the risks before using it. Limit order. A limit order is an order to buy or sell a security at a specific price or better. This means that if you place a buy limit order at $100 for a particular cryptocurrency, the order will only be executed if the price of the cryptocurrency falls to or below $100. Limit orders are used to control the price at which a trade is executed and can help traders enter or exit a position at a specific price. Liquidation. Liquidation is the process of selling off an asset or position to close out a trade or meet certain requirements. In the world of cryptocurrency and financial markets, liquidation can happen when the value of a position falls below the required margin or due to changes in market conditions. This process can be risky, as the trader may have to sell at a loss and could potentially lose more money than they invested. Liquidity. Liquidity refers to how easy it is to buy or sell an asset without affecting its price. Highly liquid assets are in high demand and can be bought or sold quickly and easily, while illiquid assets may be more difficult to buy or sell and may fluctuate in price more. The liquidity of a cryptocurrency or asset can be influenced by its market size, demand, and the presence of buyers and sellers. It is important for traders and investors to consider the liquidity of the assets they are holding or considering buying or selling. Liquidity mining. Liquidity mining is a way to earn rewards by providing liquidity to a cryptocurrency exchange or platform. This can be done by adding assets to the exchange's order book. Liquidity mining is often used to help new or emerging exchanges grow and attract traders, or to encourage the use of specific trading pairs or protocols. However, liquidity mining can be risky and may involve the possibility of losses or regulatory issues. Liquidity pool. A liquidity pool is a group of assets that can be bought or sold quickly and easily on a market or exchange. They are often used to enable trading of assets with small markets or low liquidity. Liquidity pools can be created and managed by exchanges, market makers, and other financial institutions, and they can be used for various assets, including cryptocurrencies, traditional financial instruments, and other securities. Liquidity Provider. A liquidity provider is a company or entity that helps make it easy to buy and sell assets on a market or exchange. They do this by adding assets to the market's order book and trading large volumes of assets. Liquidity providers help ensure that there are enough assets available for trades and can also help reduce market volatility. They can provide liquidity for various assets, including cryptocurrencies, traditional financial instruments, and other securities, and may use strategies such as market making to do so. Liquidity providers are an important part of the financial system and help facilitate the buying and selling of assets in the market. Liquidity Provider tokens, LP tokens. LP tokens represent ownership in a liquidity pool, which is a group of assets that can be easily bought or sold on a market or exchange. They are issued by liquidity providers, who help make it easy to trade assets on a market or exchange. LP token holders get a share of the fees or rewards from the liquidity pool and may have other rights or benefits. LP tokens can be traded on exchanges and may be bought or sold by investors interested in the liquidity pool. They can be used to provide liquidity for various assets and may be used to encourage the provision of liquidity to a market or exchange. Long. Long refers to an investment in which an investor thinks the price of an asset will go up. When an investor is long on an asset, they buy it and hold it in the hope that the price will increase, so they can sell it for a profit. Long positions can be taken in various assets, including cryptocurrencies, traditional financial instruments, and other securities. They can lead to profits if the asset's price goes up, but also carry the risk of losses if the price goes down. Mainnet. A mainnet is a live blockchain network that processes and verifies real transactions with value, like the transfer of cryptocurrency. It is important for many blockchain projects and provides the infrastructure and protocols needed for the blockchain to work. Mainnets are different from testnets, which are used for testing and do not involve real value or transactions. Mainnets are launched after development and testing and may come with a mainnet token, the native cryptocurrency of the mainnet. Mainnet tokens are used for transactions and may also be traded or used to access certain features or services on the network. Mainnets are a crucial part of the blockchain ecosystem and help many blockchain projects function. Margin call. A margin call is when a broker or exchange asks a trader to put more money into their account to meet the minimum margin requirements for their positions. This happens when the value of a trader's positions falls below a certain level and they need to add more money to maintain their positions. Margin calls are common in margin trading, where traders borrow money from a broker or exchange to increase the size of their positions. They have to keep a certain amount of money in their account to cover potential losses, and the broker or exchange sets these requirements. Margin calls can be caused by market changes, the value of the trader's positions, or other market conditions. They can be risky because traders may have to sell positions or add more money at short notice, potentially losing a lot of money. It is important for traders to be aware of the risks and manage their risk and margin requirements to avoid margin calls. Margin trading. Margin trading is when traders borrow money from a broker or exchange to make bigger trades than they could with just their own money. It is used to try to make more money off of the price of an asset, but it can be risky because it involves using leverage and can lead to big losses. Traders need to keep a certain amount of money in their account to cover potential losses and may be asked for more money, a margin call, if the value of their positions drops below a certain level. Margin trading is not suitable for everyone and has a lot of risks. Market cap. Market cap is a way to measure the size and value of a company or asset. It is found by multiplying the price of the asset by the total number of units. In cryptocurrency, market cap is used to compare the size and value of different cryptocurrencies. To find the market cap of a cryptocurrency, multiply the current price by the number of units in circulation. For example, if a cryptocurrency is worth $100 and there are 1 million units, the market cap is $100 million. Market cap can be useful for comparing cryptocurrencies, but it is not the only factor that affects the value of a cryptocurrency. Usage and technology are also important. Market maker. A market maker is a company or entity that helps make it easy to buy and sell assets on a market or exchange. They trade large volumes of assets to facilitate the buying and selling of securities or other assets. Market makers help ensure there are enough assets available to complete trades quickly and easily and may also reduce market volatility by providing a source of assets that can be bought or sold without significantly affecting the price. Market makers can provide liquidity for various assets, including cryptocurrencies, traditional financial instruments, and other securities. They are an important part of the financial system and help facilitate buying and selling assets in the market. Market taker. A market taker is someone who buys or sells assets from orders already on an exchange or market. In cryptocurrency and financial markets, market takers use orders already on the order book instead of placing new orders. Market makers, on the other hand, provide liquidity to a market by placing orders and being willing to buy or sell assets at a certain price. Market takers may pay higher fees, but can execute trades faster. Max supply. The maximum supply of a cryptocurrency is the most units that will ever exist. It is usually set by the technology behind the cryptocurrency. The maximum supply can affect how valuable and popular the cryptocurrency is. For example, cryptocurrencies with a limited maximum supply may be seen as more rare and valuable than those with an unlimited supply because there is a fixed number of units that can be owned or traded. The maximum supply may not be reached if the cryptocurrency is not widely used or accepted. The maximum supply is important to consider when deciding whether to invest in a cryptocurrency and can influence its value and popularity. Memecoin. A memecoin is a cryptocurrency that is related to internet memes or popular culture. Memecoins are often created for fun or entertainment and may not have a practical use. They can vary a lot in terms of their features, functionality, and value, and may or may not have a clear development team or plan. Some memecoins may be jokes or parodies and may not have any value, while others may be more serious projects that use their connection to internet memes to get attention or support. Memecoins can be very risky and speculative investments, and investors should be aware of the potential risks and lack of viability of these projects. Mempool. The mempool is a data structure that stores unconfirmed cryptocurrency transactions that are waiting to be added to a block. The mempool is a place where transactions are stored after they have been sent to the network, but before they are verified and added to the blockchain. The mempool is like a queue, with transactions being processed in the order that they were received by the network. The size and contents of the mempool can change based on various factors, such as how many new transactions are sent to the network's ability to process transactions, and the fees for different transactions. The mempool is important for processing and validating transactions and maintaining the integrity of the blockchain. Metamask. Metamask is a browser extension that allows users to use decentralized applications, DApps, from the Ethereum blockchain and other Ethereum virtual machine blockchains through their web browser. It is a tool for accessing and interacting with the Ethereum network and is often used by developers and users of Ethereum-based DApps. Metamask makes it easy for users to manage their EVM accounts, sign and send transactions, and access DApps from their web browser. It also lets users store and manage their cryptocurrency assets, such as Ether, ETH, and other ERC20 tokens. Metamask is available for Chrome, Firefox, and other web browsers and can be downloaded and installed easily. It is a useful tool for developers and users of EVM-based DApps and is widely used in the EVM ecosystem. Metaverse. The metaverse is a virtual world that is created by combining virtual reality and the internet. It is accessible through the internet and is being developed on blockchain technology. The metaverse is still being developed, but some people believe it has the potential to change the way we use technology and the internet. It could be used for things like gaming, education, and social interaction. Some blockchain projects are focused on building the metaverse and creating decentralized virtual worlds on blockchain technology. The metaverse is a new concept that could potentially change the way we use technology and the internet.
Mineable. A mineable cryptocurrency is one that can be earned using computer hardware.
Mining is the process of verifying and adding transactions to the public ledger, called the blockchain. Miners use specialized computers to solve math problems and get paid in the cryptocurrency for their work. This helps secure the network and encourages people to participate in the system. Some cryptocurrencies, like Ripple and Stellar, are not mineable and are instead given out by their creators. Others, like Ethereum, may change from being mineable to not being mineable in the future.
Mineable cryptocurrencies are important for the security and integrity of the network and for giving people a way to earn the cryptocurrency.
Miner Extractable Value, MEV. MEV is the profit that miners can earn when mining cryptocurrency. It is the value that a miner can get by adding transactions to the blockchain and participating in the mining process.
For example, if a miner is rewarded with 10 units of cryptocurrency for adding a transaction to the blockchain and the cost of mining is 5 units, the MEV is 5 units.
MEV depends on the value of the cryptocurrency being mined, the difficulty of mining, and the demand for the cryptocurrency. Miners may choose transactions with high MEV to increase their profits.
MEV is important because it helps ensure that miners are motivated to contribute to the security and integrity of the network by participating in the mining process.
Miners. Miners are people or organizations that use special computer hardware to add transactions to a cryptocurrency network's public ledger, called the blockchain. They do this by solving complex math problems and are rewarded with some of the cryptocurrency. This helps secure the network and encourages people to join it. Miners are important to the cryptocurrency ecosystem because they help ensure the security and integrity of the network. They get paid a share of the cryptocurrency they mine. Mining requires a lot of resources, like special computer hardware and electricity, so it is often done by large organizations. Individual miners can also join a mining pool to share resources and rewards.
Minimum Viable Product, MVP. A minimum viable product, MVP, is a basic version of a cryptocurrency or blockchain application that has the minimum features needed to work and be used by people.
MVPs are used to test if a product or service is viable and get feedback from early adopters before investing more resources into development. They help minimize risks and costs when launching a new product. MVPs can help developers and investors see if there is demand for a product and identify any issues that need to be fixed before a full launch.
MVPs are important for the development of cryptocurrencies and blockchain applications because they help ensure that resources are used effectively and that the final product is likely to be successful.
Mining. Mining is the process of verifying and adding transactions to a cryptocurrency's public ledger, called the blockchain. It helps ensure the security and integrity of the network. Miners use special computer hardware to solve complex math problems and are rewarded with cryptocurrency for their work. When a new transaction is made on the network, miners compete to be the first to solve a proof of work math problem and add the transaction to the blockchain. The first miner to do this is rewarded with cryptocurrency. Mining is important for the security and integrity of the cryptocurrency network and allows people to earn cryptocurrency through their contribution to the system. Mining difficulty. Mining difficulty is a measure of how hard it is to mine cryptocurrency. It is adjusted regularly to keep the rate at which new blocks are added to the blockchain steady. If the mining difficulty is too low, it may be easy to add new blocks, which could cause the cryptocurrency to inflate. If the mining difficulty is too high, it may be hard to add new blocks, which could slow down the network. Mining difficulty helps maintain the security and integrity of the network by adjusting the level of difficulty in the mining process. Mining pool. Mining pools are groups of miners who share their computing resources and the rewards earned from mining cryptocurrencies.
Mining is the process of verifying and adding transactions to the blockchain, and miners use special computer hardware to solve math problems and earn a certain amount of the cryptocurrency.
Mining pools allow individual miners to join together and share rewards, increasing their chances of earning a reward. Rewards are typically divided among members based on their contribution to the pool's computing power, and some pools charge a fee. Mining pools are useful for individual miners who don't have the resources or infrastructure to mine on their own. Mining reward. A mining reward is a payment given to miners for helping secure a cryptocurrency network.
Miners use specialized computer hardware to solve math problems and verify transactions, and are rewarded with a certain amount of the cryptocurrency for their work.
The mining reward is meant to encourage miners to participate and helps ensure the network's security. It is typically paid to the miner who solves the proof of work problem and adds the next block to the blockchain. In addition to the mining reward, miners may also earn transaction fees from users who want their transactions added to the blockchain. Mining rig. A mining rig is a computer system made for mining cryptocurrencies. It has specialized hardware called graphics processing units, GPUs, that can do the complex math needed for mining.
A mining rig may also have other parts like a motherboard, CPU, power supply, and cooling system.
Mining rigs can be expensive to build and use a lot of electricity. Large organizations often do mining, but individual miners can also join a mining pool to share resources and rewards.
Mining rigs are important for the cryptocurrency ecosystem because they provide the computing power needed to verify and add transactions to the blockchain.
Minting, in the context of cryptocurrencies, refers to creating or issuing new digital assets. This can include generating new digital coins or tokens, or creating unique non-fungible tokens, NFTs. NFTs are digital assets that represent ownership of a unique item or piece of content, such as art or a collectible. They are stored on a blockchain and can be bought, sold, and traded like other cryptocurrencies, but each NFT is unique and cannot be exchanged for another. Minting is the process of creating these unique digital assets.
Mnemonic phrase. A mnemonic phrase is a series of words used to recover a cryptocurrency wallet if you lose access to it. It's a secret code made of 12 to 24 words that's easy for you to remember but hard for others to guess.
You need to keep it safe because anyone with the phrase can access your wallet. Moon refers to a significant and sustained increase in the price of a cryptocurrency or asset. It is often used to express excitement or optimism about the potential for the price to continue rising. The value of cryptocurrencies can be volatile and can fluctuate quickly, so it's important to research and consider the risks before making any investment decisions. Move to Earn. Move to Earn is a program that gives users cryptocurrency or tokens as a reward for doing certain activities or tasks. These activities could be exercise-related, like walking, running, or swimming. Users earn rewards for being active, which they can use to access features or services on the platform or trade on exchanges. Moving Average, MA. A moving average, MA, in cryptocurrency trading is a tool that helps smooth out price fluctuations by creating an average price. It's used to identify trends, spot trend reversals, and provide trade signals. There are different types of MAs: simple, exponential, and weighted. Simple MAs are the most basic and average the last few periods. Exponential MAs are more responsive to recent price changes, and weighted MAs are similar but with different weighting. MAs are often used with other indicators, but they're based on past price action and may not predict future price movements accurately. Moving Average Convergence Divergence, MACD. MACD is a tool used to predict changes in cryptocurrency prices. It compares two different moving averages and produces a line and a signal line. If the MACD line goes above the signal line, it means the price might go up. If it goes below, the price might go down. The MACD is based on past prices, so it's not always accurate. It's best to use it with other tools when making trading decisions. Multi-signature. Multi-sig addresses require multiple private keys to sign transactions. They add security to transactions and are often used by groups to manage funds. Parties must agree on the number of signatures needed to sign transactions. Multi-sig addresses can be created on most cryptocurrencies using tools or smart contracts. Protecting private keys is important to secure funds.